Good morning and welcome back to Almus Market Mornings. Markets are opening to a tense backdrop. Overnight, Israel launched airstrikes on Iranian nuclear and military sites, a sharp escalation that lifted oil and gold. Closer to home, India's May CPI came in cooler at 2.8% as food prices eased. We also note with sadness the Air India crash yesterday, leaving just one survivor. JK, your thoughts on these recent developments?
Good morning, Swaraj. So, but for this unfortunate incident in India and also the Iran attack by Israel, we would have actually been celebrating today because India's CPI came at 6-year low. We had PPI in US that actually was a mirror image of CPI. So all this would have been, very good news for the markets, and it would have been upbeat mood. But I think now there's no such. It's a very somber mood just now. First of all, the tragic incident in India. I mean, my heart goes out to the families of the deceased, and it's very difficult to express our, anguish. Anyway, on the geopolitical side, something had been actually been building up a couple of days back. There was a statement from an Israeli official, sorry, saying that some missile had been fired at them by Yemen, and the oil price had been slowly going up. Gold was well supported above 3,300. Some indications of something building up, but then I think very few would have expected an actual attack by Israel on the Iranian nuclear facility. US has detached itself from these attacks, saying that this is an independent action by Israel. But then yesterday there was an indication, that UK and US had been. We had shared it in our morning broadcast as well, that UK and US officials had been evacuating some of their staff from the embassies. So yes, it creates another huge uncertainty for the markets. Oil price already up 5% today, and overall up 12% in the last 3 days. Not a good news for India. On the economic data side, India CPI came at 6-year low, as I said, at 2.82%. Month on month was also lower, at 0.27%. It was 0.62% in April. Core inflation, of course, has slightly inched up, to 4.3%. But overall, the inflation has tracked the path that the RBI has been indicating. We are now actually closer to the lower bound range of RBI's inflation target between 2 and 4. But possibly with monsoon just breaking and taking a pause, market would like to watch how it evolves over the coming weeks as far as the monsoon is concerned. And so maybe policy rate does not have right now any implication from these numbers, because RBI has already front loaded the rate cuts and also eased the monetary, rather the liquidity support through CRR cut. So we'll watch the upcoming numbers in the coming months but if some small hint that the food inflation actually decreased only by 0.5%, and that's much smaller increase that decrease that we have seen in the recent months. On the US CPI also, there was very good news. Both core and headline printed lower than expected, and it was the both CPI and PPI printing lower actually gives rise to expectation that Fed's favored core measure may also print much lower. Of course, the year-on-year number is still away from Fed's target of 2%. See, important thing is that even after 3 months, the uh, tariffs have not had their impact on the inflation numbers. Now, the fear is that possibly the tariffs may not actually reflect, because possibly the prices are not well absorbed by the manufacturers, and therefore it is not reflected in the CPI or PPI. However, we'll wait and see the July numbers also. Now, it also gives rise to my doubt that whether Fed will take note of the fact that possibly tariffs are not going to have so much of so far they have not had, and possibly if the tariff rates are going to be much lower than what have been indicated so far, the all the fears about big inflation and all that might just be watered down a bit, and Fed might slightly change their language as well. Because we are seeing the deterioration in the job market, and there is a slowdown as far as GDP is concerned. Inflation expectations were even lowered in the recent surveys and by Fed. That is the thing. I think a Fed meeting next week becomes a bit important on that basis. Otherwise, it would have been a very drab affair. So on the markets, yields came off quite a bit. The 10-year is now at 4.35%, and the 30-year is at 4.85. And these drops have been not only led by the economic data, but also due to the Iran attack on Israel, leading to safe haven buying of the bonds. Now, what's happening to the stock market is obviously negative. Now, as I have shared recently in last few days, stocks have rallied almost close to their all-time highs, and somewhere or the other, for some reason or the other, investors are likely to take profit on their positions, and that has probably started. And this warlike situation has again given rise to that sentiment increasing. So, if you look at the dollar, now, recently we've been talking about global investors wanting to reduce their US dollar and US dollar assets. And that has happened also quite a bit. Stocks were sold in US, and stocks were bought in Europe and emerging markets. All of them rallied by over 20 to 25%. And at the same time, expecting a bond market turmoil, even bonds have been sold off. Now, possibly the global investors are somewhat less positioned, or I would say they're quite much less exposed compared to a month back as far as their US exposure is concerned. I'm not saying major drop, but there has been a moderation. There are some investors who may like to buy back the US bonds, at least because of the possibility that Fed is now likely to cut. Now, as per the Fed was told, 76% probability of a cut in September. Even July is showing closer to 50, not exactly 50%, but about 48 to 49% of a cut. And October is also showing a cut of nearly 52% possible. So by December, definitely two rate cuts, and perhaps more if we have further drop in the in the growth picture or in the inflation. So that's again very important dot plot coming up next week. I'm saying that there may be some buyback of US assets by global investors that can help the US dollar. Speaking more specifically on the US dollar, euro rallied to a 6-year high, sorry, 4-year high at 1.1640, and since then it has been dropping. On profit taking, because rally of 12% that we have seen in the last few months, and that's a very large move as far for a currency as liquid as euro, and that can see a further retracement. Emerging market currencies also likely to take some hit for the by due to profit taking by investors. Now, Indian rupee, CPI and PPI obviously don't have much of a impact on the INR. Yields have already seen a much lower level, so there is a possibility that yields stall here, not going down much despite the global influence. Important thing is the impact of oil price. Now, oil prices have rallied 12% in the last 3 days, and that is not going to help. And stocks have been seeing some outflows from secondary market. Yesterday were some fairly large, about nearly 4,000 crores. And broadly, from end of May, we have been seeing outflows from FIs, and reportedly PSU banks have been buying consistently above 85.40, purportedly for RBI rebuilding the reserves. All these factors together, USD INR very strong, below 85.50 now, and possibly a test of 86 on the cards with all the global geopolitical developments and also the oil price hike. Not much data to look forward to today, but we will have the key central bank meetings next week. Japan, US, and UK. All three meetings lined up, and of course, we'll keep an eye on the geopolitics. Thank you.
Thank you, JK. And just quickly summarizing, when it comes to the markets after the US CPI print, markets are now showing two rate cuts expected this year. Next week's Fed meeting will give us access to Fed members' thinking as well, because the dot plot will be released. And of course, yesterday yields came off a bit. US 10 year at 4.35, 30 year at 4.85. Safe haven buying along with the cooler US CPI print has helped with the yields coming off. India's inflation print was also at a 6-year low by the low food inflation. But as of now, it seems there may not be a policy implication of this print since RBI has already front-loaded the cuts. Now, oil prices, the rally in the oil prices, along with the FII outflows, may keep the pressure on the rupee, and that's a theme we'll be watching out for. That's it from us today. Thanks for listening. We'll catch up next week with a fresh round of updates.